Welcome to the Startup Grind.
I'd like to introduce Dave McClure. He's basically a Silicon Valley legend. He even had his own reality TV show, although it only showed up once.
Yeah, that wasn't much of a legend.
It's cool. You have your own show. How many people say that? He's also the co-founder of 500 Startups. Dave has invested in 500 Startup has invested in 1,500, more than 1,500 companies. And three of them have actually become unicorn companies or valuation over $1 billion. 37 companies with a valuation over 100 million, and what they call ponies, so basically over 300 companies with valuations over 10 million. And you know, it's I'm just so we're just so thrilled to have him here, and so everyone, please give Dave a big welcome. So, you know, I was talking to Derek. Derek Anderson is the CEO of Startup Grind, and he was actually telling me that when you first spoke at Startup Grind like 2012, it was like you actually put Startup Grind on the map. Like before that, it was just sort of ho-hum.
I doubt that's true, but okay.
But you also scarred him in that same interview.
Yeah, well, he did all right.
And so today, I know that you've been basically tour after tour. You met with the mayor today, and saw several tours. Met with Greater Sac. So, you know, you're a really good sport to come here and just hang out with us. So, you know, as I'm looking through your background, and one of the things that sort of impressed me was as an investor, you've actually been an entrepreneur. I see a lot of the. No, it's definitely 5 years, and there's a lot of people that just graduated from Stanford with an MBA and then become a VC, but you've actually done it, been it, lived it, and so I just wanted to talk about.
Spent 25 years lost in the woods. That's how I would say it.
It's an education. So so your first startup, what brought you to Silicon Valley, and what made you, how did it come to you doing your first startup?
So I came to the Valley in 1989. Just graduated maybe about a year after graduation from Hopkins on the East Coast. I was still a programmer at the time. And I guess the first 2 years was really doing database and development programming. And then gradually that turned into a consulting business. Did some work with Microsoft and Intel in, I guess, 92 to 94.
So as a small startup, that's pretty impressive clientele.
Well, no, I was really just more a geek working for a couple of large companies. But I didn't know too much about business at the time. Actually, from 92 to 94, I was just mostly doing consulting with myself and another friend. And then between 94 and I guess 97, we kind of grew that from about 2 people to maybe 20. So it wasn't as much of a startup. It was more like a small business or a consulting shop. And I realized I didn't really know that much about running a business, and not a lot about finance, and not a lot about sales, and I really didn't know much about anything except doing a little bit of coding. So I made a lot of mistakes.
I think that's part of the learning process.
Yeah, I think it is, but I think, a lot of times entrepreneurship is sold as a very glamorous sort of profession. I think you were sort of saying something like that in the beginning. And sometimes it's lonely, but certainly a lot of times it's more just about you realizing that you're kind of clueless and that you have a lot more to learn. So just because I happen to be a decent coder and, maybe we were able to get some kind of contracts doesn't necessarily mean that you can, figure out finance or grow a company or, try and be a leader for other people. In fact, most of my time spent in that company was realizing how much I failed at not being a leader, and how much I was really, trying to just struggle with my own psychology about running a business. And I think that's pretty common. I think there's a lot of people who just, when they're first getting started, just organizing 5 to 10 people to get something done can be, kind of challenging, and you have to figure out that skill set. Sometimes you don't ever, but hopefully you figure it out.
I have to say, there's probably at least once a month I actually think about just closing shop and putting my resume out there. So,
yeah.
But you did have a successful exit, so I mean,
well, no, I don't. I think that's probably a spin on that situation. We had a company that was sort of in a tough situation. We ended up getting an exit of some kind. I mean, we probably made a little less than $1 million exit. But
It's pretty good.
well,
It's better than going bankrupt.
it's better than going bankrupt. That's actually the right statement. Right. So I had probably about I'm trying to remember, but I guess maybe about $120,000 worth of personal credit card debt, another $200,000 worth of equipment and lease debt. I had
Credit card
rental lease.
Really decent
Yeah,
financing.
$110,000 worth of credit card debt on 11 credit cards. That was some education. But with a few juggled moments, I think making a payroll and employing other people for 2 or 3 years, that actually does teach a lot of discipline.
Yeah.
Especially if you miss 1 or 2 of those, or you have to delay 1 or 2 of those, and trying to make payroll and a cash advance from your credit card. I had to do that once or twice. That was
The payrolls is a big thing.
But I think you take it a little bit more seriously when you realize other people's livelihood depends on it, and they have family and kids and mortgages, and you
depend on you.
fuck that up, and you're gonna fuck up their lives. So you kind of gotta, and they'll let you know if you fuck that up. And so when you do, it's not like it's not a small thing. You kind of get a lot of feedback, a lot of that right in your face. So I think for a lot of people who've been just learning how to run a small business of 5 to 20 people it's a lot of lessons.
So I'm going to fast forward to how did what inspired you to start 500 Startups?
Well, I think a lot of it was trying to make up for my failing at creating a startup before that was of large scale, or trying to understand a lot of pieces about how the Valley worked. I think it took me a good 15-20 years to really get a good understanding of what was going on, and I never thought I was a dumb person, but you sort of look back and realize that, wow, I could have figured that out a lot faster. And so part of it was trying to help other people figure that out faster so they don't take 20 years to kind of do that. I think there's definitely some pieces that I had been watching from other folks. I think Paul Graham at Y Combinator, and maybe Bill Gross even earlier from Idea Lab, some other investors that I thought were good. There's some things there that I thought were working. There were some other experiences I'd had that weren't as easy, and just really unwrapping the whole VC experience, the whole startup experience, and how to make that a little bit more approachable for geeks.
So did you have a vision? You saw
I had a vision.
Or was it a Jerry McClure?
Oh, that was probably after some mushrooms that I took. But,
That's another startup.
actually, that was another startup. In Colorado or Washington, I think, these days.
It's legal here too.
Yeah. Where were we going with this?
So your vision is,
visions, right?
So
Yes.
you've probably seen how things were done, in Silicon Valley. But did you feel like there needed to be a better way, or did you have a vision?
I guess to fast forward through a lot of other stuff, I was a programmer for a while. I did a small startup. Did marketing a little bit at PayPal, and I started doing some angel investing when I was leaving PayPal around 2004. Had a little bit of money from the IPO, and I really didn't know much about what I was doing at the time, but I did about maybe 13 investments over 4 or 5 years, average of maybe about $25K each. Most of that was because I didn't want to buy a house, or I didn't know what to do with real estate, so I felt like I knew startups a little bit better.
You can buy a house in the Bay Area, actually.
Probably not much. You could buy an outhouse for that much money. But out of those 13 companies, probably 3 really did well. Later, I got a job working with Founders Fund, Peter Thiel and Sean Parker, and really had good fortune to have a little bit of money they gave me to allocate. But most of those investments didn't work, and I think I was fortunate that some did. But the lesson that came out of that was, if you made a lot of investments, a few of them might work out. So a lot of the initial ideas behind 500 were around having a very large portfolio. The number 500 was kind of not just a coincidence. We really modeled a structure where probably not more than 20 to 30% of our investments got to some kind of positive exit, and probably not more than 5 to 10% of them got to really larger, meaningful exits, meaningful, 10 to 20x or more. And that had been the lesson from my personal investments and from working at Founders Fund, which you'd think other people would have maybe come upon that too. I think when I started doing investments, Christine and I, were deciding on different names, and we kind of came up with that one. And people used to laugh people still laugh, but I think for a lot of VCs, that's just a really ridiculously large number of companies. And they're always like, well, how do you keep track of them? How do you manage them?
Oh, you've exceeded the number, like three times.
Oh, yeah, that's true. But really the idea was that by doing a large portfolio construction, we'd have a more diversified portfolio. That was kind of the basics of it. But a lot of the other parts of it were not based on, mathematical construction or modeling. It was more based on, I guess, a feel for how we want to interact with entrepreneurs. And, a lot of that is a little bit more cult-like at times.
Did you have a hard time raising your first fund?
Yes. I think it took...
What was the feedback?
I shouldn't complain too much. We got it done, but it took about 2 years.
How much was your first fund, if you don't mind?
A little under 30 million, about 29 and a half. And that took most of 2 years to raise. Took the first 9 months, really almost a year, to get the first 5 million done. And, this is after I was, in my early 40s, and I had been in the Valley for 20 years, and I had worked at PayPal, had done about 40 or 50 investments, and I had even worked with Founders Fund for a little bit. So, it wasn't like I didn't have some experience, but still raising capital for the first time, it was a little bit of a challenge.
So actually,
That's a complete understatement. It was a fucking pain in the ass.
I actually had a panel of female founders a few months ago, and Baden, Mo. She basically told me how she called it the $100,000 taxi cab. Right? So
not quite, but kind of, yeah. She and her husband, I think fiance at the time. Actually, it was her fiance in the car, but she and he were co-founders. I had my car. I think my car had broken down, or it was at this shop, and I tweeted out that if somebody would give me a ride back to the office, I would listen to their pitch. And he ended up picking me up, and we ended up making a $100,000 investment. It wasn't quite just that simple, but we did sort of tell that story that way.
It was a good investment. They're doing very well. They're boomerang now.
They're doing all right. They're doing probably, I think, $3 or $4 million in revenue and profitable. They have about 20 or 30 people. Yeah. They're not the biggest story, but they're
making money.
Heaven forbid a startup that makes money. Wow. But, there was a couple other pieces that get left out of that story. Like, he went to MIT, he had gone through Techstars, I had been referred to him by another VC. He was doing gamification and email, which is the investment area that we were interested in. So it wasn't just as completely random as that, but we did sort of make that decision in a 20-minute ride back to...
I'm following you just in case you need that extra ride. And
the best part was the next round investor, Manu Kumar of Canine Ventures, actually closed the deal while we were in an Uber. So we figured the first story got written up by Mike Arrington and TechCrunch, $100,000 taxi or something.
Ride, yeah.
And so we figured, we should do the $1 million deal when we're in an Uber. So we got a couple of different sort of storylines out of that.
So has your methodology in choosing companies changed over the years? Or how has it changed? Should I just put it, how has it changed over the years?
Well, I don't really make that many of the investments anymore. There's a lot more people on the team who are doing investments. The playbook for that is still pretty similar. A lot of it was based on having a functional product and having some early customer usage or revenue. A lot of times that might only be between $5,000 to $25,000 a month. We know we're going to be wrong a lot. We'll probably be wrong 80% of the time. I should say wrong. We probably won't find a big outcome that frequently. But we hope that maybe 20 to 30% of our investments get to some kind of Series A or larger investment, and maybe eventually 5 to 10% of those get to, 5 to 10% total might get to 100 million plus sort of outcome. But the way that I sort of like to describe that simply is we think about 2% of our portfolio can get to a 50x or greater outcome. We think maybe 5% can get to a 20x or greater outcome. If we're lucky, we might get another group that's 20% that does 5x, but we're still trying to work on that piece. But if you look at those numbers, each of those sort of give you a 1x outcome, and maybe if we're smart, we can sort of steer some of the capital into winners and hopefully generate a 2 to 3x return or better. But it takes probably 10 years.
For the last batch, batch 17 that just had your demo day last week,
Yep.
the theme was beauty and the geeks, and I was kind of reading it, and you had like two tracks. You had this beauty track and the B2B track.
Yeah.
Was that intentional, or was it sort of like, wow, it's a coincidence? Were you looking for beauty companies, or?
Well, I think we do a lot of different types of investments, but out of the 40 or so companies I think that were in that batch, I think there were at least 5 or 7 that were beauty and fashion retail focused. There were another 5 to 10 that were B2B and SaaS focused. So those weren't the only things we were doing, but those were two themes that some of the folks on our team were interested in, and we'd had success previously in those categories. So
it was intentional. You were looking for.
We were definitely trying to develop. We've been trying to move some of our investments in the accelerator into more vertically focused areas. In fact, we've actually been starting funds that are explicitly for either a region or geography or for an industry vertical, and we're trying to move towards doing more of that.
Right. So one of the things I've been really impressed with as I was looking at 500 is you actually have and I don't your founders are diverse. There's a diversity component. Not only that, but there's also this.
I think you mean to say we have a few people who are not white and not male.
Right, about 30%. And also
a lot more than that, actually. I mean, I think probably if you look at the global portfolio, I don't know, it depends on what you define as a minority, but non-white founders probably close to 50%, if not more, globally. Female probably only around 20 to 30%. That's still higher than the industry average, but we're working on it.
So is that are you looking for diversity, or is it more of coincidence? You're looking at companies and they happen to have.
I believe the soundbite that I'm typically quoted as saying is, "We're greedy fucking bastards, and we're not doing this for any moral or social goals." Yeah, maybe we do, but we're trying to make money, and we actually think that there's a lot of smart people who. We're on camera, right? A lot of smart people who don't have a penis, and a lot of smart people who aren't white and didn't go to Stanford. In general, I mean, I think we're just looking for arbitrage opportunities, and we like to say that we're arbitraging racism and sexism for our own economic benefit. But we do it because we think we're going to make money. Now, that might be because other people are undervaluing those assets or those people or those businesses. We might do it because we think there's big market opportunities that other people are overlooking. Monique Woodard on our team is going to be running a fund that's investing in Black and Latino entrepreneurs and markets in the U.S. And you might think that's a social mission, but actually that's about 30% of the American market. It's a big fucking market. And so, sorry for my F-bombs here, but that's just for emphasis. So I think, we do diversity because it's a good investment, not necessarily because it's of social impact. That might happen, and we hope that does, but we're doing it because we want to make money.
The other component I think about a third of your companies are international, and I remember even listening to some VCs that will not, invest internationally.
Pretty contrarian on a lot of things, but that's also one of them.
So is that seems a little bit more of a challenge in a way, because it's there's you're not there.
There's a ton of challenges. Well, that's not true. I mean, I guess initially there was a question about like how are we going to get access to companies? How are we going to be on the ground internationally? At this point, about a third of our team is spread across 20 other countries. Then most of them were born there. Most of them are from those markets. I travel a lot. I'm probably outside the U.S. about 6 months of the year, and I probably visit 20 to 30 countries a year. But the important part, I think, is more just that there's lots of opportunities globally, and that is growing. Not to say there aren't challenges investing internationally. There's a lot less developed ecosystems in most places. There's less downstream capital. There's less historical exits. Most of those exits are smaller. But if you look at the demographics and you project forward 5 to 10 years, I don't know. You think there's going to be more or less people buying shit online next year? Think there's going to be more or less people with a cell phone or a smartphone or playing Pokemon Go next year? Think there'll be more or less people who, have delivery and logistics and payments figured out next year? I think there's going to be more. I might be wrong. If we're looking 5 to 10 years down the road, you might think that places like Pakistan or Nigeria or Indonesia, all of those places, they have large populations, a couple 100 million people. And so as the number of internet users tips above 30% to 50% to 80%, as their ability to pay online goes above those numbers, whether the average GDP is maybe only $2,000 to $5,000 per head, maybe it's even 10 or 15 in some of those markets. Those are big markets. And the amount and pace of consumer adoption, I'm not even talking about the business side, but consumer adoption in those countries is way faster than the amount of venture capital that's being deployed in those countries. The growth rates are faster. So in the US, we probably have anywhere from 500 to 1,000 VCs investing. Probably, on the order of one for every 1 million people. Depends on whether we're talking about the US market or the global English-speaking market. In a lot of countries around the world, there's one VC for every 100 million people. There's just not that many people doing venture around the world. Now, that seems out of whack.
So you're seeing more like almost like greenfield in a way.
I think, it may be tough for us to make money this year. It may be tough for us to make money next year. It may be tough for us to make money 3 years from now. But if I'm looking out 5 to 10 years, I can't see how we don't make money in 5 to 10 years. And the challenge is, do I want to wait until those markets develop to be ready for that, or do I want to get started now? And our thesis was, we can deploy a lot of small check investments in those markets, and maybe we're doing $1 million to $2 million a year in a lot of markets. Maybe we make 20 investments off that. We might do that for 5 years before we really figure it all out. But if we're deploying $5 to $10 million in 10 to 20 markets around the world, we're going to figure a few things out eventually. And so to me, it's more a question of demographics and inevitability. If we're willing to deploy capital in those markets for an extended period of time and learn, we are going to find some things that work. When those things start to work, we want to have already done 100 investments, made friends, gotten people on the ground, built our brand, and understood how those local markets work. When other people wake the fuck up off Silicon Valley Road, Sand Hill Road, or other places, when they decide those markets are ready, they're still going to have 5 years of work ahead of them. We're going to have 5 years of work already done. So to me, it's a really basic bet. Just got to bide my time and make sure that we're not deploying too crazy amounts of capital before things really start to take off. But when they do, again, we feel like we're going to make money.
Are you seeing any traction right now with some of the international companies?
Yeah, I think, we definitely see Southeast Asia taking off, particularly in Singapore, Malaysia, starting to in Indonesia. We've started a few different funds in those regions. We have one for the overall region and one for Thailand. We're working on one for Vietnam. I think India's had its ups and downs, but there's still a lot of activity going on there. Again, if I'm willing to stick with it for another 5 to 10 years, I'm pretty sure we're going to see wins. Western Europe starting to kind of develop quite a bit. China's very developed, although to the point where there's actually maybe too much capital, or at least a lot of valuations that I feel are maybe challenging. There's others that are going to be, tougher. Latin America, the Middle East, Arabic-speaking Middle East at least, and Africa are still developing markets, and there's still a lot going on there. But we're pretty bullish on the entire planet.
Yeah. So actually, just something I was going to ask you earlier. For the companies that have gone through, for your previous batch companies. And you have so many. There's so many companies. Are you able to?
That's because we're not very good. We got to have a lot.
Are you able to support them? Post going through the program, or?
Well, we do what we can, but in general, we're trying to get companies from when we invest to the next stage of capital. Usually, that's a seed stage investment that's anywhere from $500,000 to $2 million. In a few cases, we might get companies to sort of $3 to $5 million Series A's, but for the most part, we're working with them for a period of between 6 to 18 months, and probably most of that's front-loaded. Again, at our best, we're probably not. We might get more than half to the next stage of capital. In fact, we might even get 70 or 80% to the next stage of capital. But we know that probably in the long run, not more than 20 or 30%, and maybe even less than that, are going to matter. Now, I don't mean to say that the other folks don't matter. It's just from an economic basis, that's where most of our returns come from. So we have to be pretty practical and realistic about that. We have a very large team. There's about 150 people that are now at 500 Startups. There's close to probably 80 or 90 just in the Bay Area. But still, we're investing in probably 200 companies a year through the accelerator program, another 200 or 300 through other programs. So we're doing 500 companies a year, maybe 1,000 people. So it's still kind of tough on the ratio. We can't always afford to deal with every company. We do try and focus on the ones that are working.
What advice do you have for a startup that wants to apply to, let's say batch 19? What advice would you give them?
I think for most of our companies, what we're looking for is a really clear understanding of what the metrics and progress for the business is. Probably a pretty strong statement about what demographic or market you're going after and what problem you're trying to solve. There's lots of different pieces to that equation, but we're generally looking for people who are passionate about what they're doing and already have some customers to show. It may depend on whether that's a consumer or business-focused company, how big that traction is, but a couple of enterprise customers, maybe a couple hundred to single-digit thousands of B2B or small SMB customers. Probably on the consumer side, we like to see thousands of customers or at least hundreds of thousands of users. Those are kind of numbers that indicate that something of what you're doing is working and it's not accidental.
Actually, I have to say, I've been to 2 demo days at 500, and it's a lot of fun. I mean, I've been to a lot of demo days from other accelerators, and they're usually kind of formulaic. And I just have to ask about the culture. Is this something that's sort of evolved? I mean, you guys if you haven't been to the demo day, they actually do dancing. I mean, I have an image of you dancing, actually, burned in my head.
I'm not sure that's going to be a sales pitch for all the folks here, but I think, one of the points of our company culture, we have a number of different company values, but probably our most important one is a hashtag composed of 5 letters. It's called HFGSD. That's called Have Fun, Get Shit Done, Get Stuff Done, whatever you want to say. And we try and combine those. We really feel like, we want to have fun with what we're doing. It's important to have a passion for the job that you're doing, and frankly, we just don't pay people well enough. If they're not having fun, it's a pretty shitty bargain for them. So, we want people who care about what they're doing, and we want people who probably, want to make some money. But really, it's important for us to have fun. It's, part of, enjoying the work is, it's really important. And we don't take that lightly. It's really a big part of our cultural values and a big part of, what we do. When we look at whether people are working out in our company, we kind of think about, did they get stuff done? Are we having fun working with them? And honestly, if they don't succeed on both fronts, they're probably not going to be with us for that long. They just get shit done and we don't enjoy working with them, that's not really a win. If they have too much fun and they don't get enough shit done, that's not going to work either. And so we think, it wasn't completely intentional at first. It was more an internal thing, but then after a while we realized that was a pretty powerful point of differentiation for us from other firms, and it seemed to find a lot of...
Do you actually hire a choreographer?
We don't hire a choreographer. Both I used to dance a little bit when I was growing up, and my partner Christine was into ballet and other dance, so we both are dancers. That's why we like it.
She killed it with the Napoleon Dynamite.
She's great, yeah. She's amazing. But I think the point we realized is that when we have fun, other people have fun too, and that actually becomes a really strong selling point.
No, it is.
And same thing again, entrepreneurship is a pain in the ass. If you're not having fun doing it, what the hell? Making money isn't that much, fun by itself. I'm sure once you get there, it might be, but the odds are tough. So I don't think you should be denying yourself the opportunity to have fun while you're trying to get rich. That's kind of a bad bargain, given the odds. It's kind of like, you buy the house, you might as well enjoy the house while you're living in it. You may or may not make money on the house, but you should have fun along the way.
So I'm going to give you a chance to pander to the audience. the whole day you basically had almost a full tour of Sacramento. What did you think so far?
Well, I'm still learning. I don't think I've figured out Sacramento in just one day. I've been up here a few times. I think what we've really been trying to look at is what kind of areas is Sacramento good at? What kind of things are going on here that already are unique and differentiated? I think there's probably at least 3 to 5 sectors we feel are already working. So probably, ag tech and food and farming, that's one area. Healthcare and medical is another. Obviously civic tech or gov tech because of Sacramento.
Right.
Those 3 are pretty clear. I think there's a pretty decent opportunity in real estate related tech. Maybe there's some opportunities in education and a few other places. But I think sometimes it's easy to get caught up in the hot trend of the day, and the thing is you're going to be competing with the rest of the world, and particularly competing with Silicon Valley for some of those other trends. So if you want to do AI, if you want to do drones, if you want to do some other areas that are very, very competitive, just realize you got to be really good at those things, because about an hour and a half drive south, there's a very, very large number of people working on those same ideas. There may be less of them working on a few of those other ones, and so, I think for people who are working on, ag tech, working on healthcare, medical care, working on solving government-related issues, those are differentiated things. Those are kind of the superpowers for Sacramento. And so, a lot of what we're trying to do when we're working with municipal governments or metros in the U.S. and other places that aren't, Silicon Valley or New York or L.A. is what's special about those places. So to us, I think trying to figure out how do we, build brand, build sort of, community, build some critical mass around those areas, and make sure that those things are what are highlighted. We might still do a lot of the other stuff too, but I think that's what's kind of important. So I'm not saying you shouldn't build the most awesome drone-based AI delivery system, but maybe you do that for ag tech or farming, or maybe you do that for healthcare or medical, or maybe find how those tools and technologies are relevant to areas that are specific to the region.
All right. So I'm actually going to open this up to the audience, so if anyone have questions for Dave. All right, go ahead.
So, startups have such a low percentage of success as you described. So, in retrospect,
Low percentage of success for the larger outcomes. We might still have a reasonable percentage of success for smaller outcomes.
Right. So you said 10 million was the lower bound.
I think we have a probably 20 to 30% chance of getting some kind of positive exit, even though it might be small.
Okay. So the question is, like, in retrospect, when you look at it, what do you think really went wrong with those companies that
Why do startups fail? There you go.
So
So one realization is just because they don't work out for us from an investor standpoint doesn't mean they don't work out for the entrepreneur. Like, it could be the entrepreneur creates a company that's creating jobs, creating $1 to $5 million in revenue, and is sustainable. It just may not have an economic exit or return that's beneficial for the investor. So it may not be as bad as the stats that I'm quoting you. We might even have more than 30 to 50% of our companies be sustainable. I think it's probably not much more than that. But still, there's a lot of reasons why startups die. Probably the most common one is they build the wrong stuff, right? Or they don't know the customer, or it's some combination of those two. Most of the time, it's you built something people didn't want, or people didn't pay for, or people didn't pay enough for, or it cost you too much, or you got tired, or you argue with your founder. So there's lots and lots and lots of different reasons, but most of them come down to you built the wrong stuff, or you built it for the wrong customer. I think we've spent a lot of time trying to figure out how do we invest at a point when they've gotten some risk reduction around being able to build something and being able to demonstrate customer intent, right? Customer desire. So for us, a lot of people come to me and say, hey, here's my idea. What do you think of my idea? And I'm like, I don't give a fuck about your idea. I actually care what your customers think about your idea, and I care about what your customers think about your product a lot more than your idea. And so if you come up to me and ask me that question, you're kind of already out of my filter, because you haven't demonstrated to me that you have confidence in what you're building and the proof points of your customers. If you're asking for my opinion, you are still seeking validation for your idea. And I want to talk to you after you don't care what I think. You're like, hey, my customers are paying me, so this is obviously working. I don't care what you think. Give me some fucking money. Right? That's the conversation that I want to have. Now, I want to have that as soon as possible after you've got some demonstrable customers. And I want to kind of, filter for things that I think are going to grow. But most of the time, I want to talk to people who've gotten the product out the door and have some customers. Now, that sounds super basic, but you would be surprised how many people do not come to that realization. If they've got a product and they've got customers, there's still lots of ways that they'll fuck that up. But there's a lot fewer ways that they might screw it up. So then we start thinking about, do the unit economics look positive? What's the growth strategy? Can you pay for customer acquisition? Can you get customer acquisition to be scalable? Are there likely to be downstream investors? Are there likely to be, potential exit opportunities? And there's a whole myriad of questions that you answer there. But most of the times we have to make bets early, and so we're looking for smart people who can build products who have customers. And we're still going to get it wrong a lot, but that's the filter we look for.
All right, Aaron?
So back in February, there's an article, 500 startups partnering with Sacramento. What does that mean?
Well, we hope it means that Sacramento's going to give us some money. That's the goal.
Going to give you some money.
Well, so I should clarify. The statement was around Sacramento region investing in our fund. That's kind of what we're working towards. We're trying to figure out the right structure for that. But we want to kind of be able to invest in this region. We want to be able to work with other accelerators, angel investors, seed funds, maybe even the government organizations and academic organizations themselves. But a lot of it was trying to around, how do we figure out what type of ecosystem will work in Sacramento, and can we find some big opportunities there? So some of it's selfishly around the investments that we're making. Some of it's also trying to figure out, what kind of businesses and investment models are going to work here. And I'm not saying we're going to figure that all out, but hopefully we learn about what's working here and we try and dive into some of that.
In the back?
Hi, my name's Sean.
Yeah.
I was just curious, what is your opinion on the increased level of corporate venture capital, and what kind of effect,
Sure.
if any, is having on the venture capital scene?
Generally positive about that, and it is having an impact. Corporate venture capital has probably grown, I would say, at least 2 or 3x in the last 5 years. I don't know the exact stats, but it's substantial. So there's a lot of companies who haven't done innovation investing before who are trying to figure that out. There are some that already have funds. There are some that do it off balance sheet. But generally, everybody's kind of freaked out that their business is going to be, disrupted by startups that may be oversold a bit. But there's certainly lots of people out there that want to figure out how can they have a strategy to invent or invest in new products. And some of those might be developed internally. Some of those might be developed through other startups that they work with, possibly invest in, possibly even acquire. I think we're still on the journey to figure that out. Most corporate venture is not super sophisticated. There are a few like Intel and Qualcomm and a few others, Google and a few others that are experienced, but most of them are new to that game. They don't always have the same investment thesis or structure as other investors, so they may be doing it not just for economic return, they're probably doing it for strategic reasons that might be relevant to their products and services or existing business lines. The good thing for entrepreneurs is usually more capital is better, and having different reasons why people are investing might also give entrepreneurs other options to partner with those investors. I think there's lots of challenges figuring out how startups and corporates work together, and they tend to come from very, very different worlds. But at its most basic, you would argue that corporations tend to have customers and money, and startups tend to have ideas, products, and hopefully speed, ability to move quickly. Doesn't mean you're going to be able to fit all those things together, but ideally you have startups making products quickly that they then funnel into corporate customer channels, and maybe the corporate dollars help that happen.
John?
Follow up to that, do VCs like to co-invest with corporates?
The historical story is that VCs think corporate investors are clueless, stupid, slow, etc. That is less and less true these days. Still, I think, the basic recognition is that most VCs are doing it for economic returns. A lot of corporates are doing it for a combination of economic returns and strategic reasons. Most of the concerns, I think, for venture capital are really around those corporations taking board seats or having blocking rights to investment or exits from their competitors. In general, I don't think it's problematic as long as those corporations are just providing dollars and not taking board management roles or restricted contracts for how they work together. There's still going to be a little bit of conflict. Most of the corporate investors probably provide more value when those companies get to later stage, so probably after seed and Series A, more in Series B and C later stages, but sometimes they'll be involved in the earlier stages.
All right, go ahead.
Hey, my question's about learning. It sounds like a lot of the verbiage that you're using is around coming to Sacramento to figure it out and being in all different types of parts of the world.
Well, I hope people here have figured it out. I'm trying to figure it out.
Exactly, and so, I guess first of all, how do you think about it as leading a large organization? How to take that learning and make it actionable,
Right.
and then make sure it doesn't just live in.
I mean, I think there's a fundamental set of things that you probably need to learn as an entrepreneur about how do you build product, how do you do sales, how do you raise money, how do you manage people, and we all have to probably go through that set of lessons. Sometimes we can accelerate that process.
I guess you specifically, because this.
I think there's a set of lessons on the investor side that I think are also important, and I think sometimes, more than sometimes, I think often that's overlooked. I think most startup ecosystems we talk to, there's a continuing criticism of entrepreneurs by investors, usually that sounds like this. Oh, our entrepreneurs aren't as good as Silicon Valley. They're not ready yet. They still need to learn X, Y, or Z. And, we're really waiting to see them get to a level of interest before we put money down. And that's usually a bunch of bullshit. Usually the story actually is that the investor side of the equation is the weak link. More and more, the information available to entrepreneurs about how to start businesses is widely available. Online, there's plenty of information about people failing and succeeding at business. And that didn't used to be the case 10, 15, 20 years ago. It is absolutely the case now. As long as you've got a internet connection, even a mobile phone, a lot of people all over the world are seeing and hearing those stories. Still doesn't mean it's not the same as them going through it. But on the flip side, the stories about how to be a successful investor and what the strategies are there are much less common, frequent, and widely understood, and much less practiced, right? And so where I think you have a lot of communities around the world where entrepreneurs succeed and fail and learn from other entrepreneurs, and maybe the only disadvantage is they don't have as many generations of success as Silicon Valley does. Silicon Valley has 60, 70 years worth of that, an incredible amount of critical mass. In many other communities, whether that's in the US or around the world, there may only be 1 or 2 decades of that experience, sometimes even less than that. And so, the community of people to learn from is smaller. And probably the amount of time to develop those communities still is out in front. But in our opinion, usually the critical path, the critical missing pieces are on the investor side. So are there enough accelerators? Are there enough angel investors? Are there enough seed funds? Are there enough A funds? Are there enough exits? Are there enough acquirers? So, there's lots of different pieces to that ecosystem, but I often feel like the entrepreneurial side is usually the strongest part of that story. What I think is important is for entrepreneurs in communities that aren't Silicon Valley to understand what types of differential branding, marketing areas they want to go after. So if you are going to go after something like drones or something like AI or something like, that's more prevalent, you may want to go where that competition is happening at a faster pace with a lot more resources. Not saying you can't do it here, but if you look at the pace of change in the game that's being played in Silicon Valley, that's a pretty fast-paced game. Right? So if you're playing in a place where there isn't as much competition or fast pace going on, realize that you're at a disadvantage and you better be really good. However, again, if you're dealing with cows or you're dealing with medicine, you're dealing with other things, maybe that's not the place in Silicon Valley where that competition is going to go on, and maybe you have an advantage. And so I think on the entrepreneur side, figuring out what's your superpower, what's your region's superpower. On the investor side, it's how do you build that ecosystem and recognizing that, a steady diet of writing checks is what will be more likely to develop your ecosystem than sitting on your ass and complaining about the lack of entrepreneurial opportunity. I'm just saying.
Great.
So, sorry for the long-winded answer there.
If you're an entrepreneur, what are the red flags for you if you're looking at investors first?
Red flags, there's not that many red flags. I mean, if I can detect, or if I'm worried that someone is lying or crazy, I shouldn't even say that, because like a lot of people who are lying and crazy actually end up being kind of good entrepreneurs. But I think in most cases, if people are just doing it to make money or just doing it to solve the world's problems, I have some concerns about that. I mean, I think most of the time we're trying to identify expertise and passion. And so, do you have a domain of expertise because you've worked in that field? Whether you're an engineer, you're a marketer, you're a designer, you're sales. Do you have a passion for the problem that you're solving, or a passion for the customers who have that problem, which I think is actually more important. Sometimes people focus on solving their own problems and they're not representative of the market. Some people are too focused on building product and not doing sales. Some people are too focused on sales, not building product. I mean, it's hard to generalize, but you want enough crazy that they're going to find and solve new problems. You want enough sort of maturity, logic that they don't kill themselves. It's kind of really true. That borderline is important.
I have two questions. One,
Yes.
follow up to that one. What are the red flags for those of us who are looking for money? What are the red flags of the investors that we should be aware of?
Sure.
And then second, my other question is, because of the startup I'm doing, I need to have a traditional business plan. And I was told today that I need to include what's my exit strategy. And I want to know, is that really true? Is that important for someone who's just starting out to have to be identifying how they want to get out? So that's my two questions.
So the answer to those questions depends on the type of investors that you want to raise capital from. My particular preference is I really don't care about business plans. I really don't care about exit strategies. What I care is, do you have a functional product that people are buying? So most of the time, I'm not trying to figure out the next 5 years. I'm trying to figure out today, do you have a product that customers want to buy? And most of the time, my metrics for that are you telling me you have customers and maybe showing me some reports of that. Most of the time, you're not going to lie about that. It does happen. I think, I do want to know about how you grow the business and whether you write a 20-page business plan to do that, or whether you tell me, here's some marketing experiments that I'm doing and here's my thoughts about, where I'm headed next. That's probably good enough.
Well, my business plan's for insurance.
What's that?
I have to write a business plan for getting insurance.
For getting insurance?
Right, so that's not the point of my question.
Right.
It's really more, what are red flags that I need to be aware of for investors, and
Well,
how important is it to have
Yeah.
a strategy when you're not even having
I think you want to have a rational thought process about who might be an acquirer of your company. If you are raising capital from someone, you are entering into a contract with them to hopefully return their capital someday. Most of the time that's going to be through a trade sale to another company. It might be through an IPO, but that's a pretty infrequent occurrence. There might be other ways that you pay that back that are, dividend-based payments or other things. That's not typically that common. So most of the time it's an exit. Now, it doesn't mean that you have to be thinking about that today, but it doesn't mean that you should be ignorant of what the opportunities are. I think I would be a little bit concerned about investors who are asking that question too specifically. It's not that it isn't important, it's just, I think too many investors get caught up in very explicit short-term thinking. So for me, if the company is growing and generating revenue, I can probably find a path to exit. If you're just telling me, hey, I think in 5 years I'm going to sell to GE, I'm going to be like, well, okay, that's great, but you've got to build a business first before you get there. Red flags on the investor side. Again, I don't want to generalize too much because some people may want to see a business plan. Some people may want to see 5-year revenue projections. Some people may want to see your equity plan. None of those are necessarily bad. They're just a little overly specific sometimes when you're investing in early stage, which is what we do. Most of the time, just trying to see, can you build something people want to buy, and do you have a path to growth? There's so many other things that have to happen for you to become a big company and an exit that you're not going to be able to answer right now. So I'm looking for demonstrated expertise around building a product that people want to buy and that you've made some progress towards that goal. I think investors that are asking for more than that either are inexperienced or there's something else maybe going on there.
Right here. Yeah, you got it.
There you go.
Very good.
I wanted to ask you, have you ever done like equity or crowdfunding? Basically, is that?
We've invested in startups that do crowdfunding. We've worked with a lot of entrepreneurs who've raised money from crowdfunding sources, particularly for like maybe hardware products or others where there's upfront capital required.
Because I know it's hard to find VC for a business, so that might be.
Yeah, I mean, and we're not necessarily a typical large VC fund. We're typically investing maybe $100,000, but still, you may want to raise your first, $2,500, maybe even more if you're fortunate, using a crowdfunding strategy. That might be donations, that might be pre-purchase, might be you are using an equity crowdfunding site like AngelList or others to raise capital.
All right, Pam.
Hi, I'm Pamela Gustav. I'm the founder of Ride Club. It's Rideshare Independent Drivers Alliance, and we're going to actually popularize and promote rideshare drivers. Yay! So anyway, I just want to know, how do you feel about the whole rideshare economy? It's just so exciting to me. Is it just me, or am I crazy? Because I think it's amazing.
Wish I had taken Travis's offer to invest at a $10 million valuation in Uber.
How do you think it plays into your whole, strategy, or does it at all? Do you think about it at night, or?
I think about not investing in Uber at a $10 million valuation pretty much every fucking week. I actually did invest in Lyft when it was still a company called Zimride. They went through our Facebook. I ran the Facebook Incubator Fund in 2009 briefly. So we invested, I think, around $100,000 at about a $3 million valuation. That's probably one of my best investments ever. Unfortunately, I don't get the money from that. That goes to Peter Thiel and some other folks. But when I was foolish in that I was actually looking for investments in ride-sharing transportation companies, and I turned down Uber more because I just didn't have a lot of money at the time, and I thought Travis was going to be a rich playboy, which he is, but he's also a pretty fantastic entrepreneur. And then the Lyft guys came to us after we'd started 500, and I also turned them down because I thought Uber was going to crush them, which might still be true, but regardless, they're worth about $5 billion these days. So, fortunately, my partner in Southeast Asia invested in a company called Grab Taxi, which is now called Grab, and they're probably valued at somewhere between $1 to $2 billion right now. And so we have that investment. We did another investment in Mexico in a company that merged with another one that's in the ride-sharing business. I think I'm pretty interested in that field. I would say there's a lot of people who are going after that. So sometimes you got to be aware of, when everybody else thinks it's an amazing investment, it might not be the time to kind of do the investment. But then again, I've been wrong a lot.
Go ahead, James.
Thanks. James Kelly. Hi, Dave. I just want to say thanks for spending time with us.
Sure.
It's awesome. And I have a really reliable car out back.
Great.
My question is, let's say you're a guy who has a great idea, a world beater. It's just amazing.
Okay.
And you know it is. It's been proven by another startup, $10 million startup.
I wouldn't say the idea has been proven by another startup, but maybe the execution of that idea has been proven by another startup.
Yeah. What do you think the most important thing to do is? If you're a guy coming in from the outfield, you don't know programmers, you haven't lived in Silicon Valley, you're just a guy with a great idea. What's the most important next step that you can take?
Learn how to recruit programmers. Learn sales, I don't know. I mean, so I think in general we try and segment most entrepreneurs into one of two sort of categories. Can you build stuff? Can you sell stuff? And there's a few variations on those themes also, but in general on the product side, looking for coders, engineers of some kind, designers and UX folks. Maybe product management is a more generic structure there. On the sales and marketing side, it depends a lot on the type of business, whether that's a direct sales story, whether it's a channel sales story, whether it's an online marketing story, whether it's a telemarketing story. And then there's like lots of other functions that are supporting structures. So management, generally speaking, finance, HR, legal, customer support, etc. But at the stage when we invest, usually we're looking for some combination of engineering, design, UX, marketing, and sales. Maybe you throw in there sort of management and fundraising as other functions. If you're not able to do one of those things, then it might just be a nice idea.
Yeah, I have one more question. One last question. Anybody? Go ahead.
I wanted to ask you about the Bay Area and how expensive it's getting
Hi.
to do business, and also for people living there. What you think the future holds for it within that context?
For the Bay Area?
The Bay Area. And also, just to bring Sacramento, with our proximity, is there a play
Sure.
to be part of that ethos?
I wouldn't be here if I didn't think there was.
I thought it was me.
Exactly. Rich is really sexy, that's why I'm here. I think the historical, kind of stories, you can't replicate Silicon Valley, and I think, again, that's kind of BS. There are a lot of things that are, amazing or special, or at least interesting about Silicon Valley. And studying some of that history is helpful. It was actually kind of random why Silicon Valley became Silicon Valley. A lot of it had to do with Bill Shockley and why he came back home after kind of being, I think, on the East Coast at Princeton, I'm trying to remember now, and starting, both Shockley Semiconductor and to some extent teaching at Stanford. It may or may not be in that. You could even go out further back and say it was a lot of defense and research spending back in the 30s, 40s, and 50s. But for whatever reason, critical mass started happening around maybe the 60s and 70s. Actually, late 50s, early 60s, really. And that just kept building on itself. So there was a lot of network effects that were going on after that happened. Now, that also happened in Boston. And then, for whatever reason, that didn't keep happening in Boston, at least over the last 10 to 20 years or so. I think in general, what you're looking for is critical mass of talent. Usually that's coming out of universities and other corporations. Money that might come from a lot of different sources, but in the Valley it came from the first VC firms that started here. And then sort of a customer base and sort of an engineering platform, and I don't know, it's maybe hard to sort of figure out what that exact mix is, but if you kind of combine smart people and money and customers of some kind, you have a chance of creating that in other places. And it has happened in other places like Beijing, to a lesser extent maybe London, New York, Bangalore, a few other places around the world. Most of those places tend to compare themselves to Silicon Valley and say, wow, we're really not at Silicon Valley's level. But again, you're looking at 60 or 70 years worth of development in Silicon Valley. And so if you look at what New York's done in just the last 5 to 10 years, they might have done a better job than 50 years ago in Silicon Valley. Certainly Beijing has developed really, really, really fast. So I don't think it's impossible to create Silicon Valley in other places, at least at smaller scales. But you have to understand, what are the components of that? Most of it happens when you have smart people and capital coming together, and then customers and exit opportunities or liquidity downstream. A lot of other, I could go into this at much greater length. I don't think Silicon Valley is going away anytime soon. I do think there's lots of other Silicon Valleys developing both internationally and domestically. I think you have to be smart about what areas you're going to go after. You're probably not going to beat Silicon Valley in drones and AI unless you happen to have some particular reason why you're going to be better at that. You might beat them in biotech. You might beat them in a few other areas. We'll see.
So, final question.
Yeah.
Who's your favorite superhero?
Who's my favorite superhero? Well, I will answer one of two ways. My mom or me?
Mom is a good answer. But, you were actually, you're actually one of our heroes here. So
Okay.
we actually made a game with you. It works on Android, and your kids will love it. And you actually do die in this. So.
That sucks.
And then you have a rare collector's edition of. We only have a few of these made, but thank you for coming.
Oh, well,
here.
Russell, thank you very much.
Thank you very much for coming.